Roth versus traditional IRAs. Which one should you contribute to? First, let's go over a brief overview of what they are. Traditional IRAs. Traditional IRA allows you to make contributions with pre-tax dollars, meaning that money that you contribute is not immediately taxed. This could potentially lower your current taxable income. The investments within your account grow tax-deferred, meaning you don't have to pay taxes on earning until you withdraw your money from your retirement. However, when you make withdrawals, they are subject to ordinary income tax. A Roth IRA, on the other hand, allows you to contribute after tax dollars. This means you don't get immediate tax deduction for your contributions. However, the significant advantage of a Roth IRA is that you qualify withdrawals. Withdrawals are made after age 59 and a half years old and at least 5 years after the first contribution are tax-free. This includes both initial contributions and any investment in earnings. Here's a brief overview of traditional IRAs. Contributions to traditional IRAs are often tax deductible in the year they are made, which means they can lower your taxable income for that year. This can provide an immediate tax benefit. However, there are income limits. Anyone with an earned income can contribute to a traditional IRA, but the tax deductibility of the contribution may be limited or eliminated if you have access to employer-sponsored retirement plans, like a 401k, and your income exceeds a certain threshold. Taxation on withdrawals. The contribution of any investment gains within traditional IRAs grow tax deferred, meaning that although you don't have to pay the taxes now until you withdraw the money in retirement, withdrawals are subject to ordinary income tax in the year they are taken. Also, there's a required minimum distribution, or RMDs. Starting at age 72, formerly 70 and a half, prior to the Secure Act, you're required to start taking minimum distributions from your traditional IRA. These withdrawals are subject to taxation and help ensure that the government collects taxes on the deferred income. Finally, there's an early withdrawal penalty. If you withdraw funds from a traditional IRA before age 59 and a half, you are generally faced a 10% early withdrawal penalty in addition to regular income taxes, unless you qualify for specific exceptions. Next, let's go over Roth IRAs. Contributions to Roth IRAs are made with after-tax income, meaning you don't get immediate tax deductions for contributing. However, this type of account offers a different tax advantage in the long run. There are income limits for contributing to a Roth IRA. If your income exceeds at a certain level, your ability to contribute directly to a Roth IRA may be limited or eliminated. For instance, you're only allowed to deposit $6,500 as of now to a Roth IRA annually. The unique feature of Roth IRAs is that you qualify withdrawals are tax-free. This includes both contributions and investment gains. To be considered as qualified, the account must be open for at least 5 years and you must be at least age 59 and a half years old. There are also no RMDs. Unlike traditional IRAs, Roth IRAs do not have a required minimum distribution. This means you can leave your money in the account for as long as you want, potentially passing on tax-free assets to your heirs. Early withdrawals or contributions. You can withdraw your Roth IRA contributions, not earnings, at any time and for any reason without facing penalties or taxes, as long as you don't touch the earnings itself until you meet the qualified withdrawal criteria. The benefits to a traditional IRA is immediate tax deduction. Contributions to a traditional IRA are often tax deductible in the year that they are made. This can lower your current taxable income, potentially reducing your tax bill for the year. It also allows for tax-deferred growth. Any investment gains within traditional IRAs grow tax-deferred, meaning you won't pay taxes on these gains until you withdraw the money in your retirement. It also lowers your tax bracket in retirement. If you expect to be in a lower tax bracket during retirement, a traditional IRA might be advantageous. This is because you'll pay taxes on the withdrawals at your future date potentially lowering your tax rate. Finally, while most see the required minimum distributions as a potential drawback, RMDs ensure that you'll gradually withdraw and pay taxes on your savings and retirement, potentially minimizing the impact of a large tax bill all at once. So, what are the benefits to Roth IRAs? Tax-free withdrawals. Qualified withdrawals from Roth IRA are tax-free, meaning including both contributions and investment gains. This is advantageous if you anticipate being in a higher tax bracket in retirement. No RMDs. Unlike traditional IRAs, Roth IRAs do not have a required minimum distribution. This allows you to leave your money to grow tax-free for as long as you wish, potentially benefiting heirs as well. There's also an aspect of flexibility and contributions. Roth IRA allows you to withdraw your contributions, not earnings, at any time without penalties or taxes. This provides some flexibility and access to your savings in case of emergencies. Finally, it acts as a tax diversifier. Having a mix of Roth and traditional IRA accounts can provide greater flexibility in managing your tax liability in retirement. So, what are some drawbacks on a traditional IRA? Tax on withdrawal. When you withdraw money from a traditional IRA in retirement, those withdrawals are treated as ordinary income and are subject to income tax rates at that time. RMDs. As mentioned, you are required to start taking RMDs from a traditional IRA by age 72. These mandatory withdrawals might force you to withdraw more than you need, potentially pushing you into a higher tax bracket. Finally, limited tax diversification. If all your retirement savings are in a traditional IRA, you might lack tax diversification in retirement, potentially limiting your flexibility in managing your tax liability. Now, what are some drawbacks to having a Roth IRA? First, there's no immediate tax deduction. Contributions to a Roth IRA are made with after-tax income, so you won't receive immediate tax deduction as you would with a traditional IRA. Income limits. Roth IRA have income limits for contributions. If you have income exceeds a certain threshold, you may be ineligible to contribute directly to a Roth IRA. Limited earnings. While you can withdraw your Roth IRA contributions penalty-free at any time, withdrawals of earnings before age 59 and a half might be subject to taxes and penalties unless you meet certain exceptions. So, what are some potential edge cases for Roth IRAs? Early retirement with low income. If you plan to retire early and expect your income to be lower in early years of retirement, a Roth IRA might be beneficial. If you withdraw contributions and earnings tax-free after 59 and a half years old, even if you haven't reached the typical retirement age for traditional IRA withdrawals. Estate planning. Roth IRA can be advantageous for estate planning, as there are no required minimum distributions during the account holder's lifetime. This allows you to potentially pass on a larger tax-free inheritance to your heirs. Potential tax-free growth. If you are a young investor with many years before retirement, a Roth IRA can provide significant tax-free growth over time, potentially resulting in substantial tax savings in the long run. Finally, temporary low tax year. If you have a year with significantly lower income tax due to circumstances such as a sabbatical or job loss, it might be a good opportunity to convert some of the funds from a traditional IRA to a Roth IRA. You'll pay taxes on converted amount at your current lower tax bracket. So, what are some potential edge cases for traditional IRAs? High current income expecting lower income in retirement. If you have a high income tax bracket now but anticipate being in a lower tax bracket during retirement, a traditional IRA could provide immediate tax benefits during your high earning years. Desire for tax deductions. If you're looking to reduce your current taxable income and potentially lower your tax bill, contributing to a traditional IRA can provide immediate tax deductions. Phase retirement with RMDs in mind. If you plan to work part-time during retirement and your income remains relatively high, having an RMD with a traditional IRA can help ensure steady streams of income in retirement. Tax diversification strategy. If most of your retirement savings are in a Roth account, having a traditional IRA can provide tax diversification. This allows you to strategically manage your tax liability in retirement by choosing which account to withdraw from based on your tax situation. Finally, offsetting capital gains. If you have capital gains from selling investments, contributing to a traditional IRA can potentially offset those gains with the immediate tax deduction from those contributions. Here's some additional facts that you should know. For traditional IRAs and Roth IRAs, contribution deadlines. For both IRAs, the deadline for making contributions for a given tax year is usually April 15th, or the tax filing deadline of the following year. Annual contribution limits. There are an annual contribution limit on how much you can contribute to IRAs. These limits can change over time, so it's essential to stay informed about the current limits. Catch-up contributions. Individuals age 50 and older can make additional catch-up contributions to both Roth and traditional IRAs, allowing them to save more for retirement. Qualified distributions. To take advantage of the tax benefits, distributions, withdrawals from either IRA need to be qualified. For Roth IRA, this typically means having the account open for at least 5 years and being at least 59.5 years old. So, what are some recommendations that I have between choosing a Roth IRA or a traditional IRA? It really depends on your individual financial situation, goals, and expectations for the future. Here are some recommendations to help you make an informed decision. Tax bracket. If you expect your income tax bracket to be higher in retirement than it was currently, a Roth IRA might be more advantageous. Roth IRAs offer tax-free withdrawals in retirement, which can be valuable if you anticipate being in a higher tax bracket later on. Long-term growth. If you have many years until retirement and the anticipated significant growth in your investments, a Roth IRA can provide advantage of tax-free withdrawals on both contributions and earnings. Flexibility and early withdrawals. Both Roth IRA allow you to withdraw your contributions, not earnings, at any time without or with penalties or taxes. If you might need access to your savings before retirement, a Roth IRA offers more flexibility. Estate planning. Roth IRA can be beneficial for passing on assets to heirs because they don't have required minimum distributions during your lifetime. Your heirs can potentially inherit a tax-free account. What are some considerations you should make for traditional IRAs? Tax deduction. If you are seeking immediate tax benefits, contributing to a traditional IRA can lower your taxable income for the year in which you contribute. Lower current tax bracket. If you expect your income tax bracket to be lower in retirement, traditional IRAs could be advantageous. You will pay taxes on withdrawals at your potentially lower future tax rate. Require minimum distributions. If you want to ensure a steady stream of retirement income and don't mind require minimum distributions, a traditional IRA can provide this structure. Tax diversification. Having a mix of Roth and traditional IRAs can provide tax diversification, allowing you to strategically manage your tax liability in retirement by choosing which account to withdraw from based on your tax situation. Immediate tax deductions. If you are in a high tax bracket now and want to reduce your current tax bill, contributing to a traditional IRA can provide these immediate deductions. Ultimately, the best choice depends on your unique financial circumstances and goals. It's important to take your time, do your thorough research, and consult with professionals if needed to make the right decision for your retirement savings.